Good morning and welcome to Market Day Report. I am Chris Swift. We left Friday with a big positive note in all the grain markets. I'm anxious to see how we're going to start out on Sunday night and wrapping up here on Monday morning to get our started, and not too awful bad. Down just a half on the May corn, 455 and a quarter. That expires this week. July down a quarter, 469 and a half, and December corn 490 and a half, down 1.5. Let's see what our soybean market is doing. I thought it was a little bit softer. We got the July contract down 4.5 at 1214 and a half. Got the Novi beans at 1202 and a half, down 3 1/4. It's right up against that $12 handle. Let's see what we got for Chicago wheat. It's up 4.5 on the July, 668 even. That December contract up 4 1/4 at 709 and a half. If there was much of anything that came out of that report on Friday, it was probably in the wheat markets. Kansas City up 5.5 on the July contract at 678 3/4, and December up a nickel at 710 even. Minneapolis spring wheat, it's a little bit firmer as well, up 6 on the July at 726 even. December up 6 1/4 at 745 1/4. I want to invite my guest in, Brian Hoops. He is with Midwest Market Solutions. And Brian, we got a lot of information on Friday. Did you take anything specific out of it?
Good morning, Chris. Always good to talk with you. Yeah, there was a couple reports I thought that were pretty significant on Friday. The supply and demand numbers, of course, that we saw from WASD coming out and affecting our markets. And they weren't a bearish report by any means. And really the surprise, I thought, was in the corn market. And it was a bullish surprise, thankfully. The USDA finally lowered Argentina's corn production numbers as well as Brazil's production, a total of 6 million tons between the two countries. And that should mean better exports for the U.S. And they did increase U.S. corn exports by 50 million bushels. They increased ethanol usage by 50 million. I think those are justified, and it produced a 100 million bushel cut. In our old crop balance sheets, lowered the carry-in by the same amount, so our new crop balance sheets weren't quite as burdensome, and we saw a good reaction in corn as a result. Now, we saw, I thought, the little profit-taking or repositioning maybe is a better term on Sunday night on the opening and through most of the trade Sunday, and that was because the CME, for whatever reason, decided to raise margin requirements for corn and soybeans and meal and wheat. And even though we haven't had a lot of volatility, they have decided to raise those margins. That caused some of the funds to rebalance or reposition. And then commitment of traders on Friday afternoon, the fund report that I looked at saw futures contracts. Funds have gone from short 266,000 contracts of corn to only about 31,000 short. So that's a massive amount of short covering and gave us a 50-cent rally. But now we're probably not going to be able to talk about short covering any longer, as those funds are almost out of all their short positions.
So how about wheat? Wheat seemed to have the lion's share of whatever the information was on there, a 9-year low on world wheat stocks there. And we know that we had some earlier issues in the week with Russia there. Anything about it?
Yeah, I think you hit the nail on the head there. The biggest numbers I thought for wheat came out of the foreign countries, lowering the Russian wheat crop, lowering Ukraine's wheat crop, stocks falling sharply on a worldwide basis. So those are the main things that drove our wheat prices higher. Of course, that's assuming that we are going to have better export business here in the U.S. to compensate for some of those smaller yields in Russia or in the Ukraine. I don't know that that's going to be the case, but we did see good buying interest in those wheat futures. We rallied right up into some resistance. There's a strong seasonality here for Chicago to gain against Kansas City in the upcoming weeks, and I think all those numbers that we saw on Friday's reports validate that seasonality, where we're going to see a larger hard red wheat crop in the plains areas. Especially, they're going to receive a lot of rain this week. We're expected almost every day down here in Springfield to get rain, almost every day, as I said, and this is really going to help that wheat crop out. So we're going to have a big crop there. There was a surprise, I thought, that the soft red wheat crop is going to be smaller than the trade had expected, and that should bolster Chicago to gain against Kansas City, and we saw that evidence on Friday.
All right, Brian, stick with us. We're going to go away, take a real quick commercial break. Stay with us. Risk is inherent in commodity production. It can't be eliminated, but can be managed. With over 30 years of experience, Swift Trading Company has the knowledge and provides the service to meet producers' needs. For more information, visit swifttradingco.com. Welcome back to Market Day Report. We were a little bit firmer on the fat cattle on Friday. We closed a June contract up 20 at 176.15. The August was up 40 at 174.12. And after that Dece, it was up 50 cents at 181.52. I think the feeder market was a little bit softer. It wasn't much, though. The May contract up 15 at 238.80. That feeder cattle index closed on Friday at 240.61, so we're not too far apart. And I think on May the 23rd is the last trading day for that May contract. August down 15 at 250.90, all the way out to the October down 7 at 252.87. The hog market, I believe it was a little bit firmer, up 65 on the June contract at 98.37. That lean hog index was at 91.28 on Friday, and the July 40 at 101.45. I want to invite Brian Hoops back in again. Brian, we saw some things on Friday where the corn market slipped up just a little bit, and the one thing that I don't think any livestock producer was looking for was something to have to do with feed costs going up. Now we got feed costs going up, and that just kind of throws a monkey wrench in all of the high prices they paid for feeder cattle.
Yeah, you're absolutely right. You know, the prices for live fat cattle have kind of just stagnated and traded lower. The cost of feed, as you mentioned, has moved sharply higher in the last several months. So yeah, it's putting the producer at a real disadvantage. I didn't think the feeder cattle futures really reacted that badly on Friday, considering how much strength the corn market had. Live cattle did close a little bit higher, maybe a little bit of relief or hedge lifting when we did see that cash trade finally break loose, which was pretty much steady once again, even though that was a little bit of a disappointment. Early in the week, we had rallied the futures market anticipating that we'd see stronger cash trade after the prior week was stronger, and we saw those show list numbers coming in 15,000 head smaller. But boy, these packer margins are really taking a beating here, and that's going to limit the upside potential. We just received those this morning. They're about $117 a head in the red, and you just don't see the packers wanting to expand their kills when they're losing that much money. So it's not a great situation by any means. You probably have limited downside risks to an extent in the front month because of the discount that they're holding to the cash. But we may not see a lot of upside movement in here in these markets just because of that poor packer margins that we're holding and the poor margins that the feedlot manager is holding as well.
Well, and a lot of that tends to do with the weight gains. I noticed that they were up 30 pounds year over year. Week over week, I think it was down a pound, but 30 pounds. And when you times that by 524,000 head slaughter, that makes up a lot of beef really quick, if I'm not bad and mistaken.
Yeah, exactly. You're looking at 25,000 head additional cattle being slaughtered just because of the increased weight gain, and it comes at a time when we're actually killing 500,000 head less than a year ago because of lack of demand. So it's a problem. It's not bullish by any means, and so I know a lot of people want to be bullish and really think we're going to move sharply higher, and we may during the third and fourth quarters, but here during the second quarter, it's a time of caution for sure.
Yeah, and I'm really anxious to see how we're going to go into the summer with the video sales. July tends to be when the big video sales come out, and I'm going to be anxious to see what kind of inventory will be available for that. Anything real quick you see on the hog market?
In the hog market, it's really broken down technically. We moved the futures into new contract highs or above weekly resistance. And then from there, we saw a lot of selling, a lot of fund selling, commercial type selling that capped our rally. And now we're trying to look at, just retracements in this hog market to see, trying to find some support, retrace back to the upside, get back into some hedging opportunities for the producers because, their margin's getting squeezed as well.
Well, and I noticed the basis has converged quite a bit, about $9 now between it and the June contract, but still got another month to go. Brian, really appreciate you taking the time to be with us this morning. It's Brian Hoops. He is with Midwest Market Solution. And Suzanne, good morning to you.
Good morning, Chris. Love your energy. I need some of that on this Monday morning. And
Absolutely.
Always great information. God, you're so good at what you do. Thank you so much.
I appreciate that.